Hi everyone, thank you for joining my channel. My name is Wickham. Are you considering selling a profitable investment property, stocks, or bond? If so, you may be thinking of all of these profits will be going straight into your pocket. But think again. Today, I'm going to talk to you about capital gains tax, capital loss, special situations where you can be exempt from paying this tax, and some examples of how the capital gains taxes are calculated. So let's dive right in. Before we get to the details of this video, there are a few definitions associated with capital gains tax which I will explain as I move through this video. I am not a professional financial consultant, but I have personally experienced real estate taxes involved with buying, selling, and investing. So if you need professional advice, please consult a tax accountant. Since my channel is about real estate, I will be discussing capital gains primarily around the real estate market. So what is a capital gain or a capital loss? In simple terms, if you sell a capital property for more than what you originally paid for, it is referred to as a capital gain, and if you sell it for less than the original cost, then it is considered a capital loss. According to Canada Revenue Agency, capital property is any property including depreciable property if sold and would result in either a capital gain or a capital loss. Generally, capital property is used to generate income or for an investment purpose. Some examples are real property, real estate, stocks and bonds, mutual funds, arts and collectibles, and many more. The original paid price for a capital property is also known as the ACB, which stands for adjusted cost base. This is pretty much what you pay to acquire the capital property, with addition to any expenses such as legal fees, commissions, and any alterations that appreciate the property, also known as capital expenditures, aka CapEx. Since we got that out of the way, now let's talk about capital gains taxes. Capital gains taxes are the taxes you pay on a capital gain. You will pay taxes on 50% of the total value of the gain. This rate is also known as the inclusion rate. The advantage of capital gains versus other sources of income such as business or employment income, that you're only paying taxes on the inclusion rate and not the full amount. Let's take a quick look at some of the inclusion rates we had in the past. Rates have changed anywhere from 50% at its lowest to 75% at its highest. These rates can fluctuate over time and they have not been in a while, which may lead to an increase in the near future. Now let's look at an example how Canada Revenue Agency calculates capital gains tax. Let's just say you have a vacation property and you decided to sell it. If this is not your primary residence, thus it is considered a secondary residence, you will have to pay capital gains tax. According to Canada Revenue Agency, we need three things to calculate our gain or loss. 1. The amount you have or will receive, which is the sale price of the property. 2nd, the amount you originally purchased the property for. And final, any outlays and expense incurred to sell your property. So let's just say your vacation home has been sold for $500,000 and the adjusted cost base was $300,000. Also, you have had the additional legal and real estate fees of $10,000. You will add your adjusted cost base and the expenses of $10,000, which will bring the total up to $310,000. Now, you will subtract your adjusted cost base and expenses from the sale amount of the property. The total capital gains from your vacation home, therefore, is $190,000. Since the current inclusion rate is 50%, capital gains tax will be applied to 50% of the $190,000 capital gain, which is $95,000. Therefore, you will be paying taxes on $95,000 worth of total profits. Your tax rate for the taxes paid on $95,000 is based on your income tax bracket. Here's a chart of the current federal income tax rates. If you're within one of these tax brackets, your income tax rate will be the one in front of it. Let's just say your tax bracket is $97,000 to $150,000. The tax rate of the taxable capital gain of $95,000 is 26%. Therefore, the capital gain you will have to pay when you sell your vacation home is just over $24,000. That was a simple calculation, but sometimes these calculations can get complicated depending on your situation. You probably wonder, what if you're selling the home that you're currently living in? Do you have to pay this tax? So the good news is, if you're selling your primary residence, you don't have to pay any capital gains tax, but you do need to inform the sale of your property during your income and tax benefit return to claim the full principal resident exemption tax benefit. Usually, you will use two forms. One is Schedule 3 to inform any capital gains or capital losses, and the other one is to identify your property as your principal residence. What if you have two properties? Can you claim both as your principal residence? Unfortunately, no. Even if you and your spouse own two separate properties, you can only have one as your principal residence each year. Canada Revenue Agency clearly outlines what can be designated as your principal residence. It has to meet all of the following conditions. You own the property alone or with another person, if it's a housing unit or leasing of a housing unit, or you hold shares of a capital stock of a cooperative housing corporation where you have the right to occupy a unit owned by that corporation, you or your current or your former spouse, common-law partner, or any of your kids living in it at some time of the year, you designate that property as your principal residence. And it gets even more interesting. The land that you own where your home is located can be a part of your principal residence, but it's limited to 1.25 acres, unless you can prove you need the entire 5 acres as your principal residence. An example can be where a town can have rules on the minimum lot size you can own, and it can be over 1.25 acres. What are principal residence exemptions? So let's just say you had to move out of your principal residence because of work and you decided to rent it out. The good news is there are special circumstances in which you can change the use of your principal property and to be exempt from paying any capital gains if you decided to sell it after the fact. In order for you to be qualified for this exemption, you need to make an election to Canada Revenue Agency, and also there are special conditions you need to meet. Some examples of these special circumstances are if you decided to convert your entire principal property as a rental or a business property, if you convert your rental or your business property to a principal residence, or you just use a part of your principal as a rental or a business property. There could be more capital gains exemptions depending on your situation. Check in with the tax accountant. I know we talked a lot about capital gains, but there is also a capital loss. It's pretty much the opposite of a capital gain. If you sell your capital property for less than its adjusted cost base, it's considered a capital loss. If we use the same example above, now we sold your vacation home for $300,000 and the adjusted cost base was $500,000, plus legal and real estate fees of $10,000, which totals up to $510,000. This means that there is a loss of $190,000. Based on the current inclusion rate of 50%, total capital loss by selling your vacation home will be $95,000. If you have a capital loss in a given year, you must use it to offset any capital gains for that year. If you still have leftover net capital loss, you can either apply it to 3 years backwards to offset any gains occurred during those years, which is only an option, or you can carry it forward indefinitely. Sometimes real estate investors misunderstand the difference between a capital gains tax versus business income tax, which is taxed at 100%. If you're flipping houses or buying and selling real estate, you should be aware of the difference between these two. The bottom line is, if you make a profit selling a capital property, you need to report it to CRA and consult a tax accountant to guide you through the steps. This is a quick overview of how capital gains or capital loss tax works in Canada. I have also included some useful links provided by Canada Revenue Agency for you to take a look at. Hopefully this video will help you to clear out some of the questions you had. Like and subscribe to my channel. See you next time.